Well, good afternoon. We're looking at welcome to audit and assurance at skills level. We are looking at chapter one, the concept and need for assurance. So we need to look at this chapter has to do with the introductory background into audit. So we are going to define audit. Now, is a concept or is a concept that's been in existence for a long time, right? I also need to understand that audit as a concept or as a profession has also evolved over the years. Now, the audit that we are doing these days is not as what we used to have before now. So as the regulation, as time changes, the audit also adapts, okay, to the changes in time and regulation. So here we are going to start with the meaning of audit and assurance. Now, knowing fully well that audit is being regulated globally by International Audit and Assurance Standard Board, and they gave us a comprehensive definition of audit. And define audit as an independent examination of an expression of opinion on the financial statement of a business enterprise by an appointed auditor in accordance with the terms of appointment and in compliance with relevant statutory and professional requirements. Now, what this one means is that for you to become an auditor, mind you, we are looking at there are two auditors that we know. We have the external auditor, we have the internal auditor. The one that we are concerned about is the external auditor as far as this topic is concerned. So the one we are discussing here is the external auditor. So for you to become an external auditor, you have to have an independent mind. Independent mind is such that you should not allow anybody to influence your sense of judgment. Okay? So if you are given a task, you give an engagement, you're able to do an independent examination on your own. Yes, you can ask questions from the people that prepare because what you are doing, you are just checking what they have done. So you can ask questions, but you should not let your decision, which is your opinion, to be influenced by the people that prepare the financial statement. So as an auditor, your duty is to review the financial statement of an enterprise. Okay? First of all, what are you looking for when you look at the financial statement of an enterprise? You need to first of all assure the financial statements are prepared in line with applicable financial regulatory framework. That's the first thing. Then you need to also know that your financial statement must agree with the source document. Okay? So these are the two primary duties or responsibilities of the auditor. So others can now come. Now, how do we appoint an auditor? We need to also look at it here. Now, external auditors, remember, they are not staff of the organization. Most times they are appointed. And who are the people that can appoint an external auditor? There are two people: the board of directors and the shareholders. The board of directors has the mandate to appoint the first shareholders of an organ and the first external auditor of an organization. And also, when there's a casual vacancy, they can fill in that gap. Now, once it's been appointed, there has to be a document that backs up that appointment, and that document is known as a letter of engagement. So that letter of engagement signifies that there's a contractual agreement between the auditor and the client. And there are certain rules that need to be complied with when it comes to the appointment of an auditor. Okay? So that is the meaning of audit as far as this class is concerned. Do you have any question? Somebody should just type or you unmute and tell me that I can move on. So that we are all together here. Can we proceed? Hello, are we there, class?
Good afternoon, sir. Yes, sir. You can move on, sir.
Okay, thank you. The next thing, we need to look at the concept of accountability, stewardship, and agency. These three concepts, they are interrelated. You need to know, like I said, audit has been in existence for a very long time. Now, while it was in existence, what happened in those days was that there is nothing like structure as we have it now. So what happened is that you see landowners who that have estates, who that own cattle, livestock. They will look within the society and select people that are of impeccable character, people that have good character, people that their names are worth more than gold, that they cannot compromise integrity. They will appoint these people to come and appoint these people to come and be their to work for them. So what they are doing at that time is that they are rendering stewardship. What do you mean by stewardship? They are taking over the management of the business owner asset and managing it on his or her behalf. So at the end of the day, let's say annually or half yearly or maybe quarterly, he will render his account of stewardship to them. So this account stewardship rendition will entail having the presence of the owner of the livestock or the estate and his family. So they will listen as he read out his report of activities to them. Now, as he's doing that, what he's also doing is that he's being held accountable for all that transpires within the livestock or within the estate that he manages for that period of time. So he has to show accountability, how he was able to disperse the money he generated, how he was able to utilize it. All of this will now be as a result of rendering accountability. Now, where does agency come in? Now, agency comes in this point in the sense that when you are the owner of a business and you're managing the business on your own, there's no much problem because the problems are what are within your control. But as the business expands, most times you don't have the capacity to continue to manage on your own. So what do? You bring in people to help you to manage the business while you tend to other things. Now, when you bring in people to come and manage your business, those are the people that we call the board of directors and the executive management. They will manage your business on your behalf while you become the chairman. Now, these people that I just mentioned, the executive management and the board of directors, they're supposed to act in your best interest at all times. But you must always act in your best interest at all times. And that is where the agency comes in, because they are acting on behalf of the owner of the business. Agency is about what? Acting on behalf of the principal of the business. So they render this account. And now, another thing to also know about agency is this. Because of these people that are being appointed to come and run the business, sometimes the shareholders or the owner of the business, they are not too comfortable. They are not too sure that these people are representing their interests. And the reason is not far-fetched because they don't have the capacity to manage. These people have the technical skills or technical competence to manage the business. So because of that, it creates some form of doubt in the mind of the owner. He will now go and get the external auditor and ask the external auditor to oversee what they have done. If truly what they have done is in line with the arrangements that they had already put in place before they are coming on board. Okay? So that is what we talk about. So the directors, they will be the one that will now render the accounts in this new dispensation now. They will bear the financial statements. As they bear the financial statements, what they are doing is called accountability. After that has been done, they will give it to the external auditor to look at. The auditor will certify if truly the financial statement that has been prepared by the directors have been prepared in line with the interests of the owners at heart. So that is where the word assurance comes in. Because they are not too sure of what the directors have done. That is the shareholders, who are mostly the owners of the business. So they will call the auditor to come and check what he has prepared. So based on that report from the auditor, it gives some form of comfort to the owners of the business. And that's why we have what we call, that's where the word assurance engagement comes from. Do you have any question? Any question? If there are no questions, we proceed. Now, there's what we also call materiality concept. The materiality concept is a concept in accounting and auditing that explains that only information that are material are what the users of financial information will base their decision on. And if this information is omitted, it affects their decision making as well. It affects their decision making as well. So, for the auditor, he will need to examine every item in financial statements to be sure that there are no areas that have been left unreviewed or unexamined. Because if there's going to be any issue going forward, the auditor will be held accountable for negligence in the performance of his duty, that he has not done a due diligence in the course of his work. So that is what we mean by that. Now, do we have any question on what I've said so far? Hello? Are we there? Okay. So let's look at assurance engagement. Now, assurance engagement. You said?
Good afternoon. I think I'm the only one here right now.
I don't know whether it's the network.
I said
I
I'm
think
the
maybe,
only one in
I
this
know, I
car.
know, I know, I know. I think it's because of the network. Maybe they will still join later. They'll join
Oh,
soon. Maybe they're having
okay.
issues with the connectivity.
Oh, okay.
Do you have any question?
No, sir.
Okay. So we go on to looking at assurance engagement. Thank you. Now, assurance engagement, you need to understand that it's an engagement that is performed by a practitioner. Okay? And the essence is to be able to enable him to express an opinion about the measurement of a subject matter against criteria. Now, these are big ground. Let me break it down. Now, in an assurance engagement, what they do is similar to what I earlier explained about the work of the auditor and the shareholder. So, an assurance engagement is when somebody examine what has been prepared by another person, and after reviewing it, you are now to make a judgment in form of expressing an opinion whether what you have examined is in line with what's supposed to be or not. Okay, so that is what. So what you need to understand also is that audit is a type of assurance engagement. Audit is a type of engagement. So assurance engagement is broader. Okay, it's bigger. While audit is just a subset of an assurance engagement. As we go, we're going to look at other areas of assurance engagement, other types of assurance engagement. Okay? So for now, what we are saying is that whoever is in charge of that engagement, we refer to that person as a practitioner. And whatever the person is doing, the person must base his work on certain criteria, suitable criteria. You don't just work anyhow. You have to work based on the principles, or based on the law, based on the regulation. And based on that, you will be able to explain if there is conformity with the law or where there is no conformity with the law. Okay? Then, who prepares the financial statement that is being examined by the auditor is the management. You prepare the financial statement and present to the auditor for review. Okay? for review. Now, when he's done reviewing, he writes his opinion based on what he has reviewed. And that is where the expression of opinion comes in. Okay? So there are people that rely on that information. We call those people the intended users. The intended users are the stakeholders that will be interested in that particular document. We don't call them stakeholders in auditing. The term stakeholders can be permitted in CSME, but in audit we call them intended users. Who are the intended users? Examples: government, bank, customer, public, creditor, supplier. All these people, bankers, all these people are the intended users. They are waiting for that report before they can take decision based on that. Now let's look at element of assurance engagement. The element of assurance engagement has been, we are looking at that in any assurance engagement, there is need for certain criteria to be in place or certain characteristics to be in place. So these elements, or we call it attributes, I'll use the word crest, I'll use the phrase, or I'll use the mnemonics or synonym crest to explain what I mean by element of assurance engagement. So the first one is C, which is criteria. Criteria has to do with an acceptable standard of measurement. For instance, if the auditor is reviewing financial statements, he has to base it on the International Financial Reporting Standard to be sure that it's in line with that particular that regulation. That will be by criteria. R, which is the report, has to do with at the end of every assurance agreement, you're expected to write a report. Right? You're expected to what? Write a report. And your report will indicate, your opinion. So you cannot review, you cannot carry out an assurance engagement and sit on the fence. You must take a decision. That decision is what's going to influence the intended users to know what they are to do. After that has been done, what helps you to arrive at that report is the gathering of evidence, which is the E. Crest, the E is evidence. She must gather sufficient and appropriate audit evidence to be able to substantiate the fact that your report can stand the test of time. Okay? Then you have the S, which is subject matter. Subject matter is any document that is prepared or presented by the that is prepared or presented by the management to the practitioner to review is a subject matter. An example is a financial statement. Other examples are risk management report. Other examples are other information provided by management. That will constitute your subject matter. And you have the three-party relationship. The three-party relationship is made up of three people. So in every assurance engagement, you must have a practitioner who is the person that starts the engagement. You have the responsible party. That's the person that prepares the financial statement. Then you have the intended users who are going to make use of that information for their decision making. So those are the elements of assurance engagement that is represented by the mnemonic crest. Okay. Then we'll go to another one again. Types of assurance engagement. There are two types of assurance engagement, right? You have the assertion based and you have the direct reporting. Now, if you look at the assertion based engagement, right? The responsible party is the one that is going to prepare the financial statement. After preparing the financial statement or subject matter, you'll be the one that's going to review it. You'll be the one to evaluate it. Okay? Now, after the evaluation, the intended users will now make their decision based on that. Okay? Now, but in the case of the direct reporting, that is where a practitioner will come on board to examine what the responsible party has done and write a report based on that. that's going to influence or that's going to assist or aid the intelligent users in making informed decision. So that's what we mean by the direct reporting. So what is the difference between direct reporting and assertion-based engagement? It's just two. It's just one. The reason is that in the case of assertion, it is based on the responsible party that takes decision. When in the case of direct reporting, it's based on the practitioner that takes decision. That's the difference between the two. Both of them will review financial statements. Both of them will include the intelligent users making informed decision about the review or examination that has been done. So that's what you need to know about that. Do you have any question? Can I proceed? Bruce, can I proceed? Are we there?
Yes, sir.
Any question?
No question.
Okay, thank you very much. So we go to the next one, types of assurance levels. The last one we discussed was type of assurance engagement. Now we are looking at type of assurance levels. Essentially, there are two types of assurance level. You have the limited and the reasonable. What's the difference between the two? In the case of the reasonable, the practitioner is able to obtain sufficient and appropriate audit evidence in order to be able to confirm that the subject matter that he has reviewed are in conformity with in all material respects with identified suitable criteria. What does that mean? That means he's able to obtain all necessary information to substantiate his opinion. A important financial statement shows a true and fair view or not. Okay. In the case of the second one, limited assurance level, as the name imply, the practitioner is provided with limited information. Okay. The practitioner is provided with what? Related information. Now, that information might not be sufficient enough to assist the practitioner in making an informed opinion. Okay. Now, in the case of reasonable assurance, because the practitioner is very sure of the information they are able to gather, the report is always positive because he's sure of what he has done. In the case of limited assurance, the report is always negative. Why it's negative is because he's only provided with as much information that is available, not as much information that he was able to gather. There's a limitation on what he was able to gather or what was provided for him. So he's going to base his opinion based on that, and hence you have the negative report. By negative, what it means here is that because he's constrained by the inavailability of information, he cannot make informed decision. So he's going to make the decision based on what was provided. And that's why the word negative report comes in. You say that nothing has crossed my mind. Let's say there's a fraud in the organization. And they ask him, there's a fraud in this organization now. How come you did not see it? You tell them that from what you have provided for me, all the evidence of fraud has been removed. So I don't have any way of detecting whether there is fraud. So what it means is that based on the information provided, he based decision on that, and that's why we talk about negative report. Okay. Now that's what we talk about the negative report. Now we look at the statutory audit also. Statutory audits are audits that are compelled by law. There's a legal requirement that says that statutory audits should be conducted or carried out, especially for large organizations or companies. There's ready to appoint an auditor to review their financial statements and write a report at the end of the day. Okay, that's the statutory audit. Now, we also have what we call small company audit exemption. Now, before now, all companies, whether big or small, are subject to audit, statutory audit. But with the new law of CAMA 2020 as amended, that was passed in 2020, that's 1st December 2020, the law exempts certain companies from being audited via the statutory audit. So what are those things that you must possess before you can be exempted from the statutory audit? We call it the small company audit exemption. These are the things that you need to do. Number one, For the company to be exempted from audit, number one, it has not carried out any business since its corporation. That is that since it started business, it has not been able to start commence business. He just registered the business. He has not carried out any assignment or activity. Number two, it must work within the meaning. The small audit must fall within the definition of small audit. Okay? Must fall within the definition of what? Small company. Because there are certain conditions that must be fulfilled before you can say you're a small company. Okay? So, for a company to be graded as a small company, number one, it must be a private company, according to Kama. Number two, its turnover must not be more than 120 million. Okay? Number three, its net assets must not be more than 60 million. Then, number next, there must not be any alien in the organization as part of the management. Number next, there must not be any representative of government in the organization. Government appointed representative, there must not be. Okay? All of this definition, all of these requirements are what satisfy a company to be regarded as a small company, and you'll be exempted from the statutory audit. Okay? Then we'll go to the next one, eligibility to act as an external auditor. Now, for you to act as an external auditor, there are two ways you can go about it. Either you do it by self-regulation by the audit profession, or you do it by government regulation. What do you mean by self-regulation by audit profession? That is a registered body, like ICAN, will have the responsibility of admitting new auditors. They will establish process and procedure for the conduct of audit. They are going to maintain a list. They're going to maintain a list of their registered members. Okay. Then also, they also have the capacity to deal with any of their members that do something wrong. Those are the power that they have as self-regulation by the audit profession. ICAN does that. Then if you look at government, regulation by government, what that one means is that as a case of having ICAN doing that, government will appoint a body, let's say a NAPTEP or a NECO, say that they should be doing all the functions of the ICAN, conduct exam, prepare procedures and processes, maintain a registered list of members, deal with any member that act contrary to the established rules. So that is the difference between the self-regulation by audit profession and government regulation. The only difference is that the person that is appointed to do the work is what makes the difference. In the self-regulation, it's usually by professional body. By government regulation, is a body that is appointed by the government to do that work. Essentially, they will be doing the same thing. The only difference is the body that is served that responsibility of doing that. Okay. Then auditing standard also has an important role to play in an audit, because that is the framework that you can start your audit. Without the audit standard, you cannot carry out any audit, because it's established the process and procedure to be followed, and the guidelines to be followed before you can successfully complete the audit. Okay, so that is the auditing standard. The auditing standard, there are processes to having an auditing standard. First of all, International Audit and National Standard Board, they will look within the profession or environment, business environment, and look for things that are of great concern to the practitioner, the auditors. They will put it out and ask for contributions from members. When that contribution is collated, or when that contribution is being collated, or when that contribution is being put out for members' contribution, it is called the exposure draft. After the exposure draft, the exposure draft will be reviewed based on the contribution. So after that, it will be adjusted, revised to now go through the approval process of the board. Once that board approves it, it becomes an auditing standard. That's the process of standard auditing standard. Okay, and every auditing standard, it has the content. It has an introduction, objectives. That's what the essence of that standard. Definitions of some keywords. Requirement which are shown by the word "sha," that they use the word "sha" mostly. An application of other explanatory material which are for guidance only. So in Nigeria also, we have our own auditing standard. It's called the Nigerian Standard on Auditing. And this is being produced by the Financial Reporting Council in support of the Institute of Chartered Accountants of Nigeria. So if there's a conflict between the Nigerian Standard on Auditing and the International Standard on Auditing. The Nigerian Standard on Auditing, we have an upper hand over the International Standard on Auditing. The only reason where the International Standard on Auditing we have an edge over the Nigerian Standard on Auditing is if there are no corresponding local auditing standard. That is, you're only focusing on what is obtainable at the international level. That's the only time you can now rely on the ISA. But if you had a corresponding local standard, vis-a-vis the national standard, the local Nigerian standard on auditing will take preeminence over that. Okay? So that is that about what we have discussed. Any question? Any question? There are no questions. We go on to audit report. Now, at the end of the engagement, the practitioner or the auditor will need to write a report. And that report will contain information about how the auditor was able to obtain information, how he's able to present those information to arrive at an opinion that will now be relied upon by the intended users. Okay? So the report, like I said, must meet certain requirements established by law. All right? So what are the advantages of statutory audit? It increases credibility of published financial statement because when the FRS comes to organization, they want to do audit, tax audit, they always request for the audited financial statement. Number two, it confirms the management that they have performed their statutory duty correctly. It's one of their duties of the management. Okay. Number three, it provides assurance to management that they have complied with non-statutory requirements. That is, other things that needed to be followed or to be complied with, they have abided by it. Okay. It provides a feedback on the effectiveness of the internal control. So when the auditors review the audit, review the financial statement, it's going to look at the financial statement vis-a-vis internal control because the internal control is the bedrock for the financial reporting. So if the internal control is weak, it's going to affect the financial reporting. So if the internal control is strong, it's going to have an impact on the financial reporting. So it's basis to knowing the effectiveness of internal control. And it has its own limitation. Number one, sometimes the cost can be high. Sometimes you want to do an audit, the person will be charging you millions of naira. Number two, there could be disruption of business processes, especially when they are doing inventory counts within the organization. Number three, most fraud will include an attempt to deliberately conceal the truth or misrepresent information. So sometimes fraud will exist in the organization, but they will have covered it. So it takes an editor that has professional competence, due care, and skill to be able to unravel where there are fraud or fraudulent transactions in the system. So that takes us to corporate sustainability report. Now, corporate sustainability report or sustainability report is a report that shows how the company has impacted on the environment, on its host community in the year under review. Okay, it shows how much effort, how much positive impact has the organization put in place in the host community where the business is operated. So you're looking at the social report. How many schools have they built? How many people have, how many indigent family and students have they given scholarship? You're looking at the environment. Do they contribute to degrading, further degrading the environment, such as noise pollution or environmental pollution? Okay, all of this are what is contained in the corporate social responsibility or sustainability report. You need to also contain information as to how many of the workforce are physically challenged, because a corporate organization, very large ones, they must employ people that have physical challenge so that they will be known as an equal employer of labor, that there is no discrimination. Okay, so at the end of the day, every company that does this, that prepare this sustainability report, but sustainability report is always included in the annual account, the report of the organization. Shows that they are committed to rendering services to this community. And with that, we come to the end of the class for today. Does anybody have any question? Do you have any question? That's chapter 1 in a nutshell. Any question? Are we still there, Ruth?
Thank you, Mr. Afia.
You said?
Thank you, sir.
All right.
So my question from this chapter 1, we're here
Yes.
at the likely questions, or which
Good.
area would we
Now,
have questions?
if they want to ask questions on this area, they will ask questions on that assurance engagement and audit. Elements of assurance engagement. What do
Okay.
you understand by the terminology audit? What do you understand by the terminology assurance engagement? These are questions they
Okay.
can ask. And they can also ask what are the requirements for a company to be exempted from a statutory audit? Or what I just
Okay.
explained and what they expect you to write. They are not going, sometimes they might not come in direct. Then they might bring in the form of a case study, present a problem, and ask you to dissect it and come up with a solution to that problem. So pretty much that's what they will ask at that level.
Okay. Thank you, sir.
All right. Any other question?
So we'll have this chapter 1 sent to us on the group chat and the recording.
Yes, it will be there.
Okay.
It will be there. All right.
Thank
Thank
you.
you so
No,
much. All right.
yeah,
All right.
thank you.
Thank you. All right. Thank you.
Yeah, bye.